10 rules for building a portfolio that actually works for your life. Most people think investing is about picking the perfect stock, the next big crypto, or chasing whatever everyone on social media is hyping this week. But here's the truth. A good portfolio isn't built to impress strangers. It's built to protect your future, fund your dreams, and give you peace of mind. If your investments don't match your life, your goals, and your personality, even the best portfolio will fail you. So in this video, I'll walk you through 10 timeless rules to help you build a portfolio that actually works for you. Before we dive into the rules, a quick welcome if you're new. This is the Wealth Workshop. Every week, we break down investing, portfolio management, and financial psychology into simple, actionable lessons. No complicated jargon, no noise, just practical strategies that actually work for real people. If that sounds useful, you're in the right place. Now, let's get started with rule number 1. Rule number 1, know your time horizon. Before you invest a single dollar, ask yourself one simple question. When will I need this money? Because time changes everything. Money you need next year should not be invested the same way as money you won't touch for 20 years. If you're saving for rent, school fees, or a wedding in the next 12 months, putting it in volatile stocks is risky. The market could drop tomorrow, and you'd be forced to sell at a loss. But if you're investing for retirement 25 or 30 years away, short-term drops don't matter. Time gives your money space to recover and grow. So think of investing like planting trees. Some seeds grow fast. Some take decades. Plant the right tree for the right timeline. Rule number 2, understand your risk tolerance. Here's something most people ignore. It's not about how much risk you should take. It's about how much risk you can emotionally handle. Because investing is psychological. If your portfolio drops 30% and you can't sleep at night, you'll panic, you'll sell, and you'll lose money permanently, even if the market later recovers. So be honest with yourself. Are you calm during market crashes? Or do you check your phone every 10 minutes? If you're naturally anxious, a conservative portfolio may actually make you richer in the long run, because you'll stick with it. The best portfolio is not the most aggressive. It's the one you can hold through storms. Rule number 3, diversify, but not too much. Diversification is protection. It means not putting all your eggs in one basket, instead of betting everything on one stock or one industry. Spread your money across different companies, different sectors, different asset types. Because when one falls, another may rise. But here's the mistake. Some people over-diversify. They own 50 stocks, 10 funds, and 5 apps. At that point, you're just copying the entire market, while paying more fees and creating confusion. Simple works best. A few broad investments can give you all the diversification you need. Don't build a jungle, build a clean, manageable garden. Rule number 4, minimize fees. Fees are silent killers. They don't look scary, but they quietly eat your wealth every single year. 2% annual fee might not sound like much. For 30 years, it can steal nearly half your potential returns. Half. Thousands, even one. And the worst part, you won't even notice it happening. So costs low. Avoid expensive products you don't understand. Remember, every dollar you save in fees stays invested, compounds for you, someone else. Rule number 5, automate everything. Humans are emotional. Automation is logical, and logic wins in investing. When you depend on willpower to invest every month, life gets in the way. Bills come, emergencies happen. You procrastinate. But when it's automatic, money moves before you even think about it. Set up automatic transfers, automatic investments, automatic savings. This removes temptation and excuses. You pay your future self first. Wealth grows best when you stop touching it. Rule number 6. Rebalance once a year. Over time, your portfolio drifts. If stocks grow fast, they become a bigger percentage. If bonds fall, they shrink. Slowly. Your risk changes without you noticing. Rebalancing simply means selling a little of what grew too big and buying more of what became smaller. It sounds backward, but it forces you to sell high, buy low, automatically. Once a year is enough. No need to constantly tweak. Simple, disciplined, consistent. Rule number 7. Ignore the noise. Every day there's breaking news. The market is crashing. This stock will explode. Recession coming. If you react to every headline, you'll never stay invested long enough to grow. News is designed to create fear and excitement, not wealth. Successful investors don't chase noise. They follow their plan. Remember, the market rewards patience, not panic. Turn down the volume. Trust the process. Rule number 8. Have an emergency fund before you invest. This rule saves people from disaster. Before investing, build a safety net. At least 3 to 6 months of expenses in cash. Because life happens. Job loss, medical bills, family emergencies. If you don't have cash, you'll be forced to sell investments at the worst time. That destroys progress. Your emergency fund protects your portfolio. It gives you breathing space and peace of mind. Investing without one is like building a house without a foundation. Rule number 9. Taxes matter more than you think. Many people focus only on returns, but what really matters is what you keep. Taxes can take a big bite out of your gains, so be smart. Hold investments long term. Avoid unnecessary trading. Use tax-efficient accounts where possible. Small tax savings each year. Compound massively over time. It's not flashy, but it's powerful. Sometimes the best return is simply losing less to taxes. Rule number 10. Review your plan annually. Your life changes. Your portfolio should too. Maybe you got a new job, got married, started a business, or had new goals. What worked 5 years ago might not fit today. So once a year, step back. Review everything. Are your goals the same? Is your risk still comfortable? Are you on track? Not daily, not weekly, just once a year. Investing is a marathon, not a sprint. Building wealth isn't about luck, or secret strategies, or predicting the next big thing. It's about structure, discipline, and following simple rules consistently. If you follow these 10 principles, you won't just have a portfolio, you'll have a system that supports your life. And that's what real investing is about. If you found this helpful, subscribe for more simple, practical finance guides. Your future self will thank you.